In this video, I'm going to discuss the Chapter 2 Foundation 15 problem. And this is related to cost volume profit relationships or cost volume profit analysis. Sometimes we just refer to it as CVP analysis. And here we're given some information about Oslo Company. They prepared the following contribution format income statement, meaning sales minus variable cost equals contribution margin, and that's what we call it, a contribution margin format. And then this is based on sales of 1,000 units. Their relevant range is includes from as low as 500 units to 1,500 units. So the sales is variable. Obviously, the variable expenses are variable. And then the only thing that is not is this line here of $6,000. So even if we make more than 1,000 units up to 1,500, or less than 1,000 units as low as 500, we're still going to incur the $6,000 of fixed expenses. Whereas sales will change and variable expenses will change if we're anywhere off from the 1,000 units. So please keep in mind, this is for the 1,000 unit level. So the first question they ask for is, what is the contribution margin per unit? So we could simply go in there and say total contribution margin equals $8,000 based on the information given. And since this represents 1,000 units, then we could easily compute this as follows. 8,000 divided by $1,000 units, I'm sorry. So the contribution margin per unit is $8 per unit. For every unit that we sell, once we cover variable cost, we are left over with $8 per unit to cover fixed cost and or generate profitability for us. And that's the way we can think about contribution margin. Another way to do it is the contribution margin per unit is the sales price minus the variable cost. So in this case, the sales price per unit is $20. If we sell 1,000 units and it's $20,000, then that's $20 per unit. And same thing here for variable expenses. If it's $12,000 divided by 1,000, that's $12. And again, that gives us $8 per unit. Okay, so that's pretty straightforward. And the math behind it is not, what we're interested in. It's how we use this $8 per unit later on, as you will see as we continue on this problem. Second question is, what is the contribution margin ratio? All right, so let's go ahead and do that. And the contribution margin ratio is going to be the contribution margin over sales. So if they give us the contribution margin ratio, let me just write that formula. It's going to be your contribution margin divided by sales. So in this case, whether you do it on a total basis or on a per unit basis, it's still going to be the same. So this is going to be $8,000 divided by sales of $20,000. So that ratio is 40%. And again, you could have done this on a per unit basis where you would have done $8 divided by 20, and that still would have given you the 40%. And again, just like the $8 that we came up with right here, it's not so much about this math or coming up with this number, it's how we use this number later on, and you'll see in a minute. Okay, so the third question is, what is the variable expense ratio? All right, so let's go ahead and do that. So we're given variable expenses of $12,000 divided by sales of $20,000. So that's 60%. Okay. And if you notice, the idea with these two here is for you to understand that each one of them is the complement of each other. So in other words, if your contribution margin is 40%, this is what's left over from covering variable costs, then your variable cost ratio is the complement of that, which is 60%. In other words, these two are always going to add up to 100%. So by knowing one, you know the other. Then in question 4, they're asking us, if we were to increase sales to 1,001 units, in other words, sell one more unit, what would be the increase in net profit? Okay, so this is where the contribution margin amount comes in very handy. So let's say change in profit from selling one more unit. Well, if currently profitability is $2,000, then our profit after that will be $2,000 plus the contribution margin. So in other words, $8. And we can very easily now use this for what if type analysis. So $2,008. Even if you were in a loss position, okay. So let's say that this were a negative 2,000. Just make believe that it's negative 2,000. If that were the case, if you sell one more unit, it would reduce your loss by $8. So no matter where you're at, where you stand, whether you stand at a profitability area, which is where they are now, or you stand in a position of loss, either way, that same $8 for that extra one unit sold can be added on to that. So it makes it very handy. So in this case, the response is, if we sell one more unit, our profit is going to go up by $8 to 2008. All right, so now let's go to question number 5. Question number 5 says, if sales were to decline to 900 units, what would be the net profit? All right, so for number 5, we can take a different approach here, but at the end of the day, if, let's see, change in profit, or loss for that matter, from selling 100 less units. Okay, because if you recall, we were at a sales level of 1,000 units here, and now they're asking us, what if you were to sell 900 units? That's 100 units less. So you could easily say my contribution margin per unit times 100 units equals the change in profit. And this is how handy this is. So for example, this is $8 times 100, meaning profit will go down, since, by the way, mathematically we can represent this as negative if you'd like, since we're reducing sales. So if that's the case, when I come over here and I do the math with that negative there, this is going to be negative $800. So, okay, so that's the change. You got to be real careful. So the change in profit is going to be $800, and the profit, okay, or the net operating income. Let me see what they call it, net operating income or net income. Net operating income. So let's use the same verbiage. So what it means is that net operating income at sales of 900 units is going to be the profit from before, $2,000, minus the change that we just computed. So in other words, this is $1,200 profit. Okay? And if you wanted to double check that, you could do your contribution margin income statement and just verify that that's the case. And let's go ahead and do that. So sales, variable expenses equals contribution margin minus fixed expenses equals net operating income. So sales, we have $20 per unit times 900 units that were sold, so that's $18,000. And then the variable expenses, they were $12 per unit times, again, 900 units. So that gives us 10,800. So when we do this, we get a contribution margin of, let's go ahead and compute this real quick, of 7,200. Now, if you notice, our fixed expenses were 6,000. So even if I decrease profit, even if I decrease sales by 100 units, I'm still profitable because I'm still able to cover those fixed expenses of $6,000. And we knew that because we did that little shortcut calculation there. So this is going to be 7,200 minus 6,000. So there's your proof that, oh, my apologies, I put an extra zero here. There we go. There's to prove that this, the shortcut way, is the same as if we do the actual income statement. So the profit, the change in profit is $800, but the actual profit at the end is $1,200. Okay, so let's see what number 6 is all about. Let me scroll down a little bit here. Actually, let me leave 5 visible. Here's 6. So for 6, they're asking us to change the selling price by a positive $2. So in other words, instead of selling the items for 20, we're selling them for 22. And then to decrease the number of units by 100. So what would happen if we sell, and by the way, this is reducing them by 100 from the original amount of 1,000. So it's still 900 units sold. So let's go ahead and do that. Let me copy this real quick here. And now say if it's $22 per unit times 900 units, then that gives us some number. Well, it's 19,800. That's our revenue or our sales. And then my variable expenses remain the same, so that's still going to be 10,800 as we had here in number 5. That's still the same. So then our contribution margin goes up, obviously. And our contribution now is $9,000. The fixed expenses are still $6,000, and then this is $3,000, our net operating income. So by increasing the sales price by $2 per unit, we were able to increase our profit to $3,000. And if you wanted to do a little shortcut, you could just say, look, the increase is $2. The difference, $2 times 900, that's 1,800 more than this. And anytime I do a shortcut approach, I always verify with the actual income statement just to make sure that I did it right. But you could just grab that extra $2 times 900, and that'll be 1,800 times 1,200. That's your $3,000. Number 7, if the variable cost per unit increases by $1. So now we're talking $13 per unit of variable cost. If the variable cost increased by $1, spending on advertisement increases by $1,500. That means fixed expenses go up. So instead of it being $6,000, now it's going to be $7,500. 6,000 times 7,500. And unit sales increases. Let me see. Sorry. Unit sales increase by how many units? Bear with me. By 250 units. What would be the net operating income? Okay, so every time we're being asked to change the number of units, go back to your baseline of 1,000 units. Okay, just to make it simple. So instead of selling 1,000 units, what if we sold 1,250 units? First thing I want to verify is that within the relevant range for this cost structure? And it is. So let's go ahead and figure that out. So let me go ahead and copy this. Actually, let me copy the whole thing. Okay. So the sales price is still $20. That doesn't change. So we go back to the old defaults. 20 times, in this case, we said now it's going to be 1250 units. So let's go ahead and do that. So 20 times 1250. That gives us $25,000. And the variable costs remain the same. That's 10,800. Oh, my bad. I'm sorry. Yeah. The variable cost, I'm not doing number 7. Yes, sorry, my mistake. The variable cost would increase by $1 per unit. So this would be 13 times 1250. So let me just go ahead and do the math here. So our variable expenses would be 16,250. And then on top of that, they're saying that fixed costs went up by 1,500. So that's 6,000 times 1,500, not times, plus. And that gives us 7,500. So under that cost structure, we would have a net operating income of 1,250. There are a few changes there. So it's just keeping track of those changes that occur in the analysis, that's all. Then on number 8, we're being asked for the break-even point in sales, number of units. Okay, so let's go ahead and do this in 2 ways. We could use the basic equation method, I guess you could call it. It's where we say profit equals the unit contribution margin times the quantity sold minus, bear with me here, minus fixed costs. So if I want to find out what the break-even point is, so let me write that, break-even point in units, then I'm going to let this profit amount equal 0. So I'll go in here and say 0, so that it's break-even, equals this formula, times the quantity minus fixed costs. Okay? We know what the contribution margin per unit is. That's $8 from, and by the way, we're referring, when we do this calculation number 8, we're going back to the original data that we started with. Okay, so it's none of the changes we did afterwards. It's this original information in which we get $8 per unit for contribution margin and a contribution margin ratio of 40%. So so this would be equal to 0 equals 8 times Q, which is what we're trying to figure out, minus the $6,000. So if we do our math, our algebra here, this is going to equal $6,000 because we bring the 6,000 to the other side, equals 8Q, 8 times Q. Oops, I didn't put the equal sign, my bad, sorry. Equals 8Q. And then if we do a little bit more algebra and we divide by 8 on both sides, then we're left with 750 equals Q. So what that means is the quantity that I need to sell in order to break even, to have a 0 net operating income, is 750 units. So that's one way of doing it. An easier way is to use that information as such. So the break-even point can be viewed as total fixed cost divided by the contribution margin per unit. And technically, that's what we're doing right here. We're grabbing the $6,000 and dividing them by 8. That's exactly what we would do here. It's just here showing you the algebra as to how we arrive at that. So let's go ahead and do that just for completion's sake. We're going to go in here and say 6,000 units is the fixed cost divided by 8 contribution margin per unit. And again, we get the 750 units to break even. So this is a much shorter way of doing it. If you want to do it this way just because it might make more sense to you, that's fine. But that's what, we do the algebra to be able to come up with these simplified approaches to get break-even analysis. And I should be clear here, this break-even formula is break-even point in units. Okay, so that's in number of units. Whereas if we go to number 9, let's contrast that. This is break-even point in dollars. And we can verify the same information both ways, so let's go ahead and see what I'm talking about. If we use the equation, then we have in that equation, same thing, profit equals contribution margin ratio times sales minus fixed costs or fixed expenses. So from the original computations, we figured out that the contribution margin ratio is 40%. So let's see how we use that 40%. So I'll go in here and say, if I want to break even, I need sales of 0, just like before, equals 40% times sales minus $6,000. So when we solve for this, and maybe I should be more clear here, let me put the parentheses, or the brackets, I'm sorry. All right, so there we go. So if we simplify this, this is 6,000 equals 40% times sales. So when we divide 6,000 by 40%, we get sales, and then this means that this equals $15,000 equals sales. So in other words, for us to break even, we need to have $15,000 worth of sales. And by the way, that's the same as the 750 units here, because if you multiply the 750 units times the sales price of 20, you get that 15,000. Okay? Another way of doing it, break-even point in sales, in dollars, is fixed cost divided by contribution margin ratio. So notice these formulas are very similar, but one gives you, let's go ahead and highlight this one. This one gives you the break-even point in units, and then this one will give you the break-even point in dollar amounts. Now, this is the algebra behind it. You can, go and do the algebra, and if it makes you feel better, do it that way. But this is the shortcut way. Fixed cost, 6,000 divided by 40%. So that's where, this comes from. Once you do the algebra, it gives you this very simplified approach. So if we go ahead and do that, just for the sake of completion, I'm going to do that. 6,000, oops, it's not a 6. 6,000 divided by 40% gives me 15,000. Again, same answer. Okay? Whether you figure it out this way, 750 units times $20, or you do this, $15,000 divided by 20, you still get the fact that you need to sell 750 units to break even. My apologies for the long delay there. I didn't notice I was recording. But let's go ahead and go back now to this idea here. And just to show you how this works, okay? Just to like do the proof, I guess we could say. Let's go ahead and put the original information. So we had sales. Then we have variable expenses, contribution margin, fixed expenses, and net operating income. So sales were $20,000. So I'm just putting in the original information. This is $12,000. Let me go ahead and do a line right here. And then this is $8,000. 6,000. And this gave us $2,000 profit. So this is all the original information. So now let's look at what they're saying here. If change in sales is 5%, so in other words, let's go ahead and put it here, 5% more, then we would have 20 times 1.05. In other words, the whole 20,000 plus 5%. So that would mean that sales are $21,000. At the same time, variable costs will go up by that same 5% because we are selling 5% more. So this will be 1.05. And when I do this math here, we get 8,400 as the contribution margin. Fixed expenses, they remain the same, 6,000. And when we do the profit, we get $2,400. Now, let's go back to the idea here. So, by the way, this would be 5% more as well, just like I did here, because you're selling more units, you're incurring more variable costs. Fixed expense, they stay the same. So the idea with the degree of operating leverage is that if percentage sales change by 5% positive, percentage profit changes by 20%. And how do we verify that? Well, you get the difference of these two, which is $400, and then divided by the profit from before. So let's go ahead and do the percentage increase in profit, just to verify that it is 20%. It's going to be the difference, 2,400 minus 2,000, that's an increased profit of 400, divided by the original's net operating income of $2,000, and that's 20%. Okay, so if you understand how this function works, then you wouldn't need to test this, but it's nice to kind of see that it actually works. So the change of 5% in sales gives us 20% more in profit, and that's what this is all about. Okay, then on number 14, let's go ahead and do number 14. Let's see what we're being asked to do. 14, assume that the amounts of the company's total variable expenses and total fixed expenses were reversed. In other words, assume that the total variable expenses are 6,000 and the total fixed expenses were 12,000. Under this scenario, and assuming that total sales remain the same, what is the degree of operating leverage? Okay, so let's go ahead and keep this one visible so we see how that works. So we said that the formula for degree of operating leverage equals contribution margin divided by net operating income. So what we need to do is we need to figure out what that would be. So let's go ahead and reverse this stuff. We would have, they're asking us to have this as $6,000. Oh, I didn't do the formula there. So 20,000 minus 6. And then this, the fixed cost would be $12,000. So we would still have a profit of $2,000. It's just that now what you can see is that this company is very different from the original company. The original company had fixed expenses of $6,000 relative to the $20,000 in sales. This new company has fixed expenses of $12,000 relative to the sales of 20,000. So what you could see is that this second company is maybe more machinery intensive or more dependent on a cost structure that is fixed as opposed to variable. Okay, so how does that change the degree of operating leverage? Let's go ahead and do this right here. It would, oh, I'm sorry, I should have put this as an equal sign. I keep doing that. There we go. Degree of operating leverage equals that. My bad. Okay, so the contribution margin here would be $14,000 divided by 2,000 for profit, and that would give us a contribution margin, a degree of operating leverage of 7. So what that means is that if you have a change in sales, let's say of 5%, the change in profit is way larger for a more fixed expense kind of company. And I think that's what the next question is about. So let's go ahead and see what 15 says. Using the new degree of operating leverage that you computed in the previous question, what is the estimated percent change or increase in net operating income of a 5% increase in sales? Yes, same thing. So I'm going to scroll down a little bit here, and I'm going to copy this because I want to emphasize the similarity between these two. So this is 15 now. They're saying, based on the information on 14, if we have a 5% increase in sales, in other words, sales go to 21,000, what would be the percentage increase in net operating income? So we can use this quick little formula here to figure that out, just like I explained, but let's go ahead and put it over here. So the degree of operating leverage is 7. So if sales go up by 5%, profitability would increase by 35%. And I'm not going to prove this. If you'd like, you can go ahead and prove it. But what you'll have is you'll have a profit here that's higher than $2,400. And the reason that's the case is because less of the cost is in variable expenses. In other words, our contribution margin per unit is much larger. So any change in sales can really change profits. Okay, and that's how you would use that degree of operating leverage. This concludes the foundation problem video for Chapter 2 on cost, volume, profit analysis.